Hi, this is Mark Item with HONU Trading with a week in review for May 8th, 2023. First of all, disclaimer, education only. Risk management is always your primary focus. Follow me on Twitter at HONU MGMT, HONU Management. And if you find this valuable, take a moment to like and subscribe. We're going to change things up a little bit today. I'm going to put the education segment first, and we're going to graphically look at how the big cap stocks, the biggies, are bullying the indexes through what's called looking at a heat map. And it'll show how weak breadth is offset by the two big cap stocks. The week in review, hey, much ado about nothing. If you went to sleep last Friday, woke up today, you'd think, wow, I didn't miss anything. Financials aren't out of the woods yet. The question is, who's next? Earnings season mostly done, and we're going to take a look at a baker's dozen worth of charts in TradingView that have the 90, 90, 90, the earnings rank, relative strength rank, and composite rank, and they're trading very close to the 52-week high. So I still want to be a bull. Hopefully, this guy, the tired bear, is showing up. And the breadth just has not pulled its weight this week at all. 3 big red days. And even with Friday's big rally, I was surprised that the net new highs were only 32. By the way, the source is the new high-low list on investors.com from IBD. So now our education segment. This is a heat map provided by Unusual Whales, and it graphically shows how big each individual stock is relative to the index overall. So this shows clearly that Microsoft and Apple are nearly 1/8 of the entire S&P 500 index. Now they both had good weeks, especially Apple on Friday. But Google and Meta, not so much. Amazon, virtually unchanged. Energy sector got smashed. And financials mainly had a big drop as well. One thing, because they're much smaller now, the financials don't have as big an impact on the rest of the index. This is how we've normally looked at it, just simply the ratio between the equal weighted and cap weighted SPY, with the two big stocks rallying. Now it's a quarter of the Qs, an eighth of the S&P, so it's not surprising that this is headed to new lows. The equal weighted mid caps versus SPYs, not really any change on the week, and the IWM, the small caps, actually probably got a smidgen better. But when you look at it this way, you clearly see how big the big caps are really affecting the indexes. So that's a heat map, and that shows you something new. For the week in review, again, we're still in that 415, 420 overhead resistance on SPY. Really kind of a boring week if you just look at the week as a whole. A lot happening in the week. Chop on Monday, banks fell out of bed, rallied back a little bit. Pre-Fed chop, the J-Pow, K-Pow from the Fed meeting. Chop after that, getting ready for Apple. Then we get Apple that turns into a Gapple, turns higher. So we've got the AVWAP, the anchored volume weighted average price from the Fed meeting. This is something I learned from Brian Shannon at Alpha Trends. And if you think of the average price, average volume weighted price, this is basically the cost basis over time if you bought every single share from that moment on. So right out of the water, you're underwater here. And then on Friday morning, suddenly was Apple gaps higher. Now you're making money. The green line that looks like a flat line on the 15-minute, this is the AVWAP from the all-time high. So we have yet another week where we close above that. Now the Qs, even more boring. They were absolutely unchanged on the week. I think that's 0.1%. Chop, banks don't have as much of an impact on the Qs. Pre-Fed chop lasted longer. J-Pow, K-Pow, pre-Apple chop, and Gapple. Now let's take a look at a different way of measuring risk on or risk off. And a hat tip to Chris over at Chiovaco Capital. If you haven't watched his weekly review, it's a little longer, 35 minutes, but it is great perspective. And this is where I got this from. we're looking at the S&P 1500. That's the 600 small cap, the 400 mid cap, and the S&P 500, the large cap, we're all familiar with. So this is the composite of all of those in ratio to the risk-off asset, 3 to 7 year Treasury bonds. So this clearly shows us in the COVID crash what risk-off looks like. Then as all the money gets injected into the system with the stimmy checks and the COVID money, this is what risk-on looks like. Most of 2022, risk-off again, and now it's like, what? This is another log on the fire where this is a difficult and somewhat confusing market. Now, if we move higher out of this, if stocks resume outperforming bonds, then we will probably be looking at a soft landing in the economy. If we drop out of this, we're probably looking at a hard landing, but we'll let the data tell us which way it's going to go. Financials, not out of the woods yet. I'm just going to show the XLF. You know what's happened to the regional banks, especially, and the bigger banks as well. But here's where Silicon Valley Bank failed, and a waterfall down into this 30 to 31 level that goes all the way back to the great financial crisis. Then it rallies out of it, fell out of bed this week. We closed almost a full dollar below where we closed last week. Now Berkshire, which is the biggest component of the XLF, they reported today, and I haven't seen the exact details, but I do know that they beat on earnings and revenues. So maybe that'll help move things higher tomorrow. For earnings season, we're pretty well done. There's a couple of growth names in Airbnb and Roblox. PayPal is a component of the XLF, although much smaller than most of the others. Most of the big ones are out of the way. So now let's go over into a chart review in TradingView, and we're going to look at a baker's dozen worth of stocks that have the 90, 90, 90 ratings from IBD. That's a 90 plus on earnings, 90 plus on relative strength, and a 90 plus on the composite ratio. So let's go over to TradingView and check it out. Okay, here we are in TradingView, and I've got a weekly chart on the left, logarithmic, which means equal percentage is equal distance on the vertical. And I've got a 30-week moving average to give you an indication of the long-term trend. On the right-hand side, we have a daily chart with a couple of EMA clouds from Ripster, the 8, 21, 50, and 200-day moving averages. So if this is blue, that means the 50 is above the 200. If this is green, the 8's above the 21. If it's red, then the 8 is below the 21. If this is gray, that means the 200 is above the 50. So many of these, now there are 13 of these, a baker's dozen, and very few of these actually might have any kind of a viable setup. Remember your time frame. I like to be a swing trader. I want to own things for a few days to a few weeks. So virtually none of these are viable for my time frame. Where A.G. Gallagher has a problem. This is an all-time high, but look how far it's come, how quickly. It's gone from 180 to 215 in just a matter of weeks. Great chart, not viable. Microsoft, come a long ways, well above the 30. Everything is stacked in the right order over here. You had the golden cross, if you will, where the 50 crosses above the 200 here. We gapped higher on earnings. Again, maybe this was viable, but not right now. Lulu, big congestion zone here, but broke out, and now we're into the overhead resistance here. Big gap higher on earnings. Not viable right now. Hershey, good Lord, how much chocolate can we eat? This has gone vertical from 215 to 275 just this year. Again, in my humble opinion, not viable right now. Pulte Home, same thing. Look how far that's come, how fast. From 37 to 67. It's nearly doubled. Now, you've got a little bit of a consolidation here, but I can't really define any kind of a risk-oriented trade here. TriPoint Home, even more impressive on the upside, but again, that's not viable. Novartis, Now that is a rocket ship. In just 1, 2, 3, 4, 5, 6 weeks, it's gone from 84 to 104. Oh, sorry, that's not buyable at this point. You've missed that one. Salesforce, now I'm going to use this one as an example of perhaps where you might find a trade setup. This is not a recommendation. So Salesforce had a big decline, rallied back above the 30, that turned higher, and now we have a situation where you might have a reasonable amount of reward to risk. Now, if it moves higher, it could get up into the 215, 220 range. Now, over here on the right-hand side, this is where I'm going to define the breakout as above the 200 level. And you could set your stop down below, but if this was a breakout that failed, personally, I don't want to give it all the way back down there. If it breaks out and fails, I want out fairly quickly. And a lot of breakouts have in fact failed, so I'm not going to give this one the benefit of the doubt. But if it works, I'm risking under $5 to potentially make 15. That's the kind of thing you look for in a trade. Again, this is not a recommendation, but that's how you might frame one. Copart rallied right up into all-time highs. Again, come a long way very quickly. It's going to have to consolidate before I'd be interested. CNM, Core and Main. Never even heard of these folks before, but they've rallied very far, very fast, and there's a lot of overhead resistance. They're a relatively recent IPO. You could consider this being the breakout from the IPO or the institutional due diligence phase, as defined by the life cycle trade. SMCI, gap higher on earnings. You had to catch that one very quickly, but that's not buyable right now. Takeda Pharmaceuticals, nice pullback there, but I think this is an ADR, so there's a lot of intraday gaps. Fiserv, the 13th in our baker's dozen. You're sensing a theme here. It's come a long way very quickly, and we're right up into all-time highs. So maybe not necessarily buyable right now. So finally, remember what my buddy HONU says: small losers win. Take care and trade well.